Okay, so hello everybody and welcome to this MN2054 bite-sized lecture that I'm going to be giving on business plan and financials. So obviously financials are a really important part of the business plan. They have to make sense and they have to show viability. So it's really important that we get this bit right. I'm also going to provide you via Canvas with some tools that you can use to map out your ideas and to present your business plans and financials within the business plan. Okay, so what we're going to be covering in the next 20 minutes or so is starting off with a little bit about personal finances and why they're so important. Then we're going to look at the foundation really for all financial forecasts, which is the price that you can sell the product or service that you're providing at. We're going to look at building a budget, and then we're going to look at some of the main financial statements, the cash flow and the profit and loss forecasts that you're going to need to be able to put in place to show us the viability of your business idea. So personal finances are important. So for this and for the following module for 2559, what you are going to need to do is to generate as much funding as possible. And the majority of that is obviously going to come from, if you are moving forward to 2559, from the fund that we've got in place to help you seed your business ideas. But it's also important to understand that to get a business idea off the ground, you're going to need to have your own finances, and that can come from your own savings, family loans, etc. But you can also get finance from bank loans and government grants as well. But it's important to remember that bank loans or grants will not cover all that you need to set up a business idea if that's what you want to do to move forward. They always look for a contribution, usually 50% from the person from their own finances. As I said, for 2559, this isn't going to be an issue because the funding that we provide for you here is risk-free. And it's not a grant, it's not a loan, as we've said before. It's a gift to enable you to test out your business idea. Research is in big bold letters here, and I really can't go into tell you how important the research element is. So Karina will have mentioned this before. But research into the market gap and the customer need are important. Okay, you have to identify that the product or the service that you provide is needed in the market, and that you have a unique selling proposition. In other words, why your customers are going to come to you over a competitor. And then we start off with the first of the financial questions, which is about pricing. I've mentioned about business model canvas there, and I'm going to be doing another little 5-10 minute session, which will be uploaded as well into this week's folder. Business model canvas is a really good way of scoping out your business, playing around with the idea to see if it works and to see where the gaps potentially are. So if we look at pricing, so where do we get pricing from? How do we know how much to sell our products and services for? And again, this comes back to research. So we've got things that are called trade associations, and they will be able to give you an idea of what price others within that association are selling their products or services at. So the building trade use this quite a lot. They will give an idea of what an hourly rate is for, a bricklayer or an electrician or whatever, so that you can match that price as closely as possible, so that you're not outpricing yourself. Business-to-business inquiries. So going to another business and finding out how much they sell a product or service for, getting a quote, doing a mystery shopper type survey. Can give you a lot of information about what a particular company is good at, what they're bad at, and where they set their pricing point. Rent investigation. So asking potential neighbours or searching online. So this could be the costs involved in this are actually quite important. So going to neighbouring shops or speaking to businesses in the neighbouring area can have a major source of information for you to start building your business plan. So competitive analysis is really important when it comes to price. So secret shopping and online shopping, as I've already mentioned, but what you need to make sure is that you aren't underpricing yourself either. So if you're doing something that's completely novel or new in the marketplace, nobody else is doing it in quite the way that you're doing it, then you can be more expensive. People will pay for value. Industry trends. So with COVID and everything else going on at the moment, industry trends are fluctuating. Prices of things such as food are going up and down, and will have an impact on the price that food vendors, as an example, are selling their products and services at. Documentation and demand for a product or service. So we're talking about the basic economics of business startup here. So if there is a defined amount of supply within a market, and that level of supply decreases, then what we usually see is the price in the market increasing. If you flip that around, if there's a lot of people supplying the product or service in a particular market and not much demand, then price decreases. So we want to try and be on the right side of that supply and demand curve, where there are not many people supplying what you are providing, but a lot of need or perceived need in that marketplace for that. Hence, we can charge more for the product or service. We also need to think about costs as well. So a purely service-based business tends to not have too many costs. But if you are manufacturing something or producing something, then you need to take into account things such as direct labour that's used to produce the products and services, indirect labour, used to provide supporting services to the business. So that could be things such as accountancy, could be general management of the business. Direct materials, so the materials that you will use in the final product or services to be purchased by your customers. So for an example, a coffee shop, their direct materials will be things such as coffee grounds, will be milk, will be cups, saucers, and so on. Overhead expenses. Okay, so as it says there, those are absorbed by the business and factored into the selling price as a percentage of the direct labour cost. So what overheads are, these are the things that tend not to change with regards to the amount that's sold. So going back to the direct cost that we mentioned before, the more cups of coffee that you sell, the more that you're going to spend on coffee grounds. An overhead doesn't change with the amount that you sell, and these can be things such as rent, can be your rates, could be your website costs, for instance, as well. Okay, and also you can build the overhead rates into this as using an equation to actually give you a percentage of how much of your labour costs are actually overheads. And this then leads us to break-even analysis. Okay, so this is a tool that we would use to show how much sales volume your business needs to start making a profit. Okay, so break-even essentially is where you are selling a certain amount of products or services. The business therefore isn't losing any money, but it isn't making any money either. In other words, you're breaking even. The business is covering your costs. But you have to make sure that all of your costs are factored into this break-even analysis. Okay, so that would include all of your overheads and all of your direct costs. So our fixed costs, as we've said, revenues per unit. Variable costs vary with the amount that's actually produced. Okay, so our fixed costs are paid whether or not any units are produced, and the variable costs vary directly. And those, as I said, need to be both taken into account. Okay, so as an example there, fixed cost for producing 100,000 widgets is £30,000 a year. The variable costs are £2.20 for materials, £4 for labour, and 80 pence as an overhead. So that actually gives you a total of £7. If you sell a widget for £12 each, then that is the equation. Okay, so 3,000 minus 12 times 7, minus 7, I should say, gives you a break-even cost of 6,000, a break-even amount of 6,000 units. So what that's saying is we need to sell 6,000 of those units to break even. Anything above that 6,000 units is profit onto the bottom line. So an example of some of the costs listed out there. Okay, so we've got our product and our service there. Okay, the cost of the goods sold for the product and for the service, £30.22. Our fixed costs therefore might be £2,000 a month for rent, and these figures I'm just pulling out of the air really. £600 a month for utilities, £1,200 a year for insurance, and so on and so on. And we would list our costs out like this so that we can see it, a little bit easier. So financial documents. The startup document is important because that details any information about capital expenditure. So in other words, equipment that you might need to buy. The cash flow and the profit and loss, we'll go into that in a minute, and the balance sheet, okay, which is a financial snapshot of the worth or perceived worth of the business at that point in time. So again, I've pulled these figures out of the air. So this is a fairly large size startup, and what we're looking at there is the costs that this fairly large startup would need to get off the ground. So we might have £75,000 for a building, £20,000 for the land, £30,000 for remodelling of the business, fixtures and equipment, inventory, and so on. Okay, so looking at those figures, that's a fairly hefty amount. With your small startups, you're not going to be anywhere near that. But I just wanted to really demonstrate all of the things that businesses need to take into account when they're looking at startup as a project cost. Okay, then we look at sources of revenue. Okay, so where is this money actually going to come from? So we've got there an example. So we've got £156,000 from a loan that's going to go towards those various different parts. We've got £35,000 from an owner's input there, and if you look, there's a big chunk there from the owner as working capital. Okay, so what working capital is this is money that's used to financially keep the business afloat as it's growing. So the three main or the three main financial statements, I should say, that we look at and we'll be expecting to see from your business plans are the balance sheet, the profit and loss forecast for a year, and the cash flow forecast for a year as well. So I'm not going to worry too much about the balance sheet at this stage, but the cash flow and the profit and loss statement are really important. Okay, so the cash flow from a future perspective, we're looking at how much you're forecasting in terms of inflow and what your outflow is going to be. Okay, and what we're looking for there is for your business to show a net inflow over that period of time. Okay, profit and loss statement, it says history there, but what we're going to be looking at from that perspective is forecasting what your profit and loss is going to be over that period of time as well. So we're going to look at it on a monthly basis. So just to clarify that from a cash flow perspective, we're looking at cash inflow and outflow from operations. Okay, so what we mean by that is the cash that's being generated by your business activities. Okay, you can use assumptions from market research and industry averages, but it is important that the assumptions are as accurate as possible, which is where your market research is actually going to come in. So in other words, how many, again, going back to an example of coffee houses, how many cups of coffee are you likely to sell in a month? How many cups of coffee are you likely to sell in a day? Okay. Look at the seasonality, so the trends as well that you might have. So obviously, using the example of a coffee shop again, more people drink coffee during colder weather. Your inventory purchasing. So how much are your stocks of raw materials going to be on a monthly basis? And use a number of different ways to project sales. So look at a best case scenario, a worst case scenario, and have somewhere in the middle as well that you can use. Also with COVID and things happening as well, what effect is that going to have on sales? And don't think about it just from a negative perspective. Think about it as a positive aspect as well. Is there any way that you can take advantage of the situations that you find yourself in? Last one's important there. Can the business sustain itself in slow periods? So if you haven't got that much cash coming in, then how are you going to sustain yourself? Okay. So is that from cash injections until the business grows to a certain level, or does it mean that you've got to potentially scale back on your operations? That is something that businesses are looking at continually in the current circumstances, especially the hospitality sector due to the lockdowns and so on. So as I said, we look at it on a monthly basis, and this is a really simplified version of a cash flow. So we've got month one there. We start off with £25,000 in the bank, cash in hand, and the first month we make £12,000 worth of revenue from sales and business operations. That means at the end of the month we've got £37,000 available cash, less the expenses that we've got, which are 14, means at the end of the month we've got £23,000. So that £23,000 becomes our opening cash statement at the start of month two. As you can see there, revenues have increased to 19,000, means we've got cash in hand there 42,000, less the expenses which have gone up because we've sold more, means at the end of the month we've got 24,000. Okay, 24,000 starts off month three. Again, we increase the revenues, available cash goes up, expenses go up, but we still, making the right direction in terms of the cash coming into the business and going out. So in 3 months, we've gone from £23,000 to £26,000. So there's a net increase of £3,000 over the course of that month, that quarter. So profit and loss statements measure the company's sales and expenses during a period, but they also look at, as it says there, the expenses related to the revenue. okay, and shows the company's financial progress. So cash flow is the most important for startup businesses because businesses can go for quite a long period of time, either just breaking even or even making a small loss, as long as they are maintaining positive cash within the business. Very simply, and we'll be doing this on a monthly basis. But in the first year there, this is a yearly statement, you can see there's gross sales of 300,000, less COGS as cost of goods sold, our direct costs in other words, 218,000 gives us a gross profit of 82,000. And then if we take our operating expenses or overheads away from that, then that gives us a net profit before tax of 24,000. Okay, so the gross profit and the net profit are the two figures that really show that the business is growing and performing in the way that it should. So the balance sheet, again, this really is for giving a financial snapshot of the business. We don't really need to, or you won't need to add this into your business plans at this stage, but you do need to have an idea of what the balance sheet is about. Okay, so it illustrates, as it says there, what the business owns, what it owes, and what the business's net worth is over a given time. And it's basically a simple arithmetic equation. So we look at assets minus liabilities, and we tally that up against the cash that the business has and the share equity that the owners have. Okay, so as it says at the bottom there, total assets plus total liabilities plus total capital and liabilities. So our assets, what are our assets? Fixed assets could be inventory, accounts receivable. So in other words, people that owe you money, and the cash or cash equivalent. Shareholders' equity and liabilities could be share capital. So if it's a limited company, there will be potential share capital there. Retained earnings as well, and that gives you the total equity. And then liabilities are things such as long-term loans, short-term loans, accounts payable, in other words, money that you owe to other people and other businesses, and that is the basis, as we've said. So total assets should equal total shareholders' equity and liabilities. There we've got an example. This business has got cash of 6,600 and is owed 6,200. It also owns tools and equipment that are worth £25,000. So our total assets are 37,800. So these should balance out. Okay, so liabilities, so what we owe to people, 30,000. What we have in terms of capital stock and retained earnings is 7,800. And you can see that the figures totally match there. So the next steps for you, okay, research your business and your production costs. When Karina and I look at these business plans, one of the first things that we're going to do is look at the financials and try and work out exactly where you've got those figures from. Okay, so you need to be able to show us that you've researched these ideas. Develop your overheads and break-even analysis. Okay, look at your startup costs and then prepare that cash flow and profit and loss forecast. Okay, so what I'm going to do now is just quickly show you a spreadsheet that I put together a couple of years ago, which I will put up on the Canvas site for you to use. That will do all of the hard calculations for you. Okay, so basically what we've got here is spreadsheet, and there's various different tabs at the bottom. So we've got sales forecast, we've got cost forecast, we've got cash flow, we've got profit and loss, and we've got key ratios. Okay, so if we look at our sales forecast, anything that's in yellow you don't touch. Okay, You can't break the spreadsheet. If it does mess up, then you can just download another copy. But let's just look at the first 3 months of trading here. Okay, so let's say that we are selling our product for £20, and that isn't going to change over 3 months. And we're going to make 100 sales in the first month. We're going to make 300 in the second, and we're going to make 800 in the third. And again, I'm just pulling these numbers out of the air. If you have more than one product or service, you can replicate those up to 4 times. Okay, but I'm just using this as one product or service. So you can see here it's calculated my total sales. Okay. Then if we move to our costs forecast, as you can see, the number of orders are already put in there. So if for the first month we say our costs are £2, and they aren't going to change for the first 3 months, then you can see that our costs are automatically calculated for us there as well. Okay, and those are totaled at the bottom. And again, you've got another 3 areas for the other products or services that you might have. So if we move on to the cash flow, and this is a bit more in depth than the cash flow that I showed you on the presentation, but what we have here is essentially the same. We've got an area here that focuses on income, and we've got an area here that focuses on our expenditure. Okay, so we've got sales invoiced already in there, and what we need to do is to transfer that into whether or not those are cash sales or sales via credit. So let's make it simple. Let's do all as cash sales for the moment. So we've got 2,000, 6,000, and 16,000. Okay. There's also a pre-start block here as well, which allows you to put any grants in, or loans, or your own funds. So let's say we're putting in £10,000 of our own funds. Okay, so you can see these are all totaled up at the end as well, and each one of these is for the first 12 months. Okay, so now we go down to the receipts. So these are the purchases, the expenditure. So we can see here that for each month we've got a different figure for expenditure. So let's again just make things easy and just say these are cash purchases that the business is making: 200, 600, and 1600. Okay, so those are our direct costs. We're also looking at other costs as well. Now these are the overheads. So these could be, you could have, let's say, £100 a month for rent and rates. Just again using figures out of the air here. £25 a month for insurance. £50 a month for internet. And again, remember what I was saying, these don't change, okay, with the number of sales that you make. Advertising, say £50 again. Your accountant, let's say £50 a month there. Ooh. And so on. So there's various, and you can add more things in there if and when you need to. Okay, so we can see now that it's started to calculate things at the bottom for you. So what we've done here is we've started off. Okay, our initial opening balance for that month is 2,000, as you can see, and our total payments are 475, which means we've got a net cash flow of 1,525. If we add that to our opening balance, that gives us 3,525. That then becomes the opening balance for the next month, and as you can see, 6,000 sales, or income, I should say, £875 expenditure, net cash flow 5,125, plus the 3,525 from the previous month, gives us a net cash inflow of 8,650, and that then again goes on to become the opening one. And you do this for every month, okay? And what we're looking for there is for a steady, realistic increase in the amount of cash that you've got coming into the business over a period of time. Profit and loss. Okay, so there isn't anything really to fill out in this form. As you can see, all of the calculations are actually done for you from the sales forecast, the cost forecast, and the cash flow. But just to give you an example, we've got sales here at 2,000, our materials purchased 200, costs of sales therefore 200. That means our gross profit is 1,800, so that's 2,000 minus 200 gives us our gross profit. As a percentage, that's 90%, so we're working on 90% GP, gross profit, which is a really good business. Anything over about 60% gross profit is usually pretty good. Then we've got all our fixed costs. Our total fixed costs there are 275. Minus the 1,800 gives us a net profit of 1,525. And this drawing section at the bottom here is where you can start to work out how much you are able to pay yourself. Okay. The final part on the sheet gives you some ratios. It also works out your break-even sales, okay, as a percentage. Works out your net profit before tax and your net profit as a percentage of sales. So it will give you all of those figures that you need for your business plan. And as I said, this will be up on the Canvas site for you to use and to start playing around with. Okay, and that's it from me. See you in the seminar later on in the week. If you have got any questions, please bear in mind that my office hours are on Thursdays and Fridays, and also my one-to-one sessions are on Thursdays and Fridays as well. Okay, all of that information is in the Canvas site. Look forward to speaking to you soon. Thanks.